Hello traders and investors! Welcome to another video from Strong View, where we focus on bringing topics that really help trades to be profitable in the market. Most traders are not losing money because their strategies do not work. They are losing money because their strategies only work under perfect conditions. In backtests, everything looks clean and predictable. Spreads are fixed, execution is perfect, and the market behaves exactly as expected. Real markets are very different. They are noisy, uncertain, and constantly changing over time. Many strategies are built to exploit very specific historical patterns. They rely on over-optimized parameters, curve fitting, and fragile assumptions. As soon as volatility changes, liquidity shifts, or market structure evolves, these systems start to fail. This happens far more often than most traders realize. That is why focusing only on profit is not enough. In this video, we're going to talk about resilient strategies. Strategies designed to survive uncertainty, different market regimes, and long periods of time. Strategies built not to look impressive in perfect scenarios, but to remain functional when conditions are far from ideal. Instead of focusing on maximizing returns, we will focus on what really matters in long-term trading: robustness, stability, and controlled risk. Topic 1. What finding resilient strategies really means. Finding resilient strategies is not about searching for the best indicator or the perfect entry signal. It is about designing systems that can tolerate uncertainty and imperfection. Markets are not stable systems. They change behavior, volatility, liquidity, and structure over time. A resilient strategy accepts this reality instead of fighting it. Resilience means the strategy can be wrong many times and still survive. It means performance degrades gradually instead of collapsing suddenly. A resilient strategy is not designed to be perfect. It is designed to survive. Topic Do's. Simplicity as a foundation of resilience. One of the most important pillars of resilience is simplicity. Simple strategies tend to be more resilient because they rely on clear and limited logic. Fewer rules mean fewer failure points. Each additional condition added to a strategy increases complexity and reduces adaptability. Complex strategies often look impressive in backtest. They adapt very closely to historical data and produce smooth equity curves. However, this same complexity becomes a weakness when market dynamics change. What worked perfectly in the past may stop working entirely in the future. Simple strategies may not capture every market move, but they are easier to understand, easier to validate, easier to debug, and easier to maintain over time. This transparency becomes a major advantage when trading real markets for years instead of months. Topic 3. Parameter robustness and avoiding curve fitting. Another critical aspect of resilience is parameter robustness. A resilient strategy does not require precise input values to function properly. It should remain profitable across many different combinations of parameters. Performance should not depend on a single optimal configuration. Peak-shaped optimizations, where results look good only in a very narrow sweet spot, are strong indicators of curve fitting. These strategies are optimized for the past, not prepared for the future. In resilient strategies, performance remains relatively stable across wide parameter ranges. Small changes in inputs do not destroy results. If parameters are slightly shifted and performance remains similar, the system has a much higher probability of surviving real market conditions. The goal is not to find the best parameter set. The goal is to find stable parameter zones where the strategy remains consistently functional. Having a vast set of parameter configurations means that you have many options available to adjust the bot to perform better when the market changes. Topic 4. Market regimes and long-term survivability. Resilient strategies are profitable across different types of market behavior. This includes up markets, down markets, sideways markets, different years, and different macroeconomic environments. No market condition lasts forever. Trends end, volatility expands and contracts, and correlations change over time. A strategy that only works in one specific market regime is not resilient. It may perform well for a period of time, but it carries a high risk of long-term failure. A resilient strategy may perform better in some conditions than others, but it should not completely stop working when the market environment changes. Surviving multiple market cycles is one of the strongest signs of true robustness. Topic 5. Execution tolerance and real-world trading conditions. Another often overlooked element of resilience is execution tolerance. Backtests usually assume ideal trading conditions, but live trading is far from perfect. Real markets include spread variation, slippage, and execution delays. Over time, these factors have a significant impact on performance. We know that there are some strategies that operate better, and in some cases, only with raw spreads. However, if you are not looking for this type of strategy, it needs to run securely in most market conditions. A resilient strategy must tolerate worse than expected execution. If a few extra points of spread or minor slippage turn a profitable system into a losing one, that strategy is fragile. Systems that survive realistic execution costs are far more likely to perform consistently in live trading environments. Topic 6. Risk management as a core design element. Risk management is not an add-on in resilient strategies. It is part of the core logic. A resilient strategy starts showing decent results with low-risk configurations, such as small stop losses and no hedging. Exposure is controlled at all times. The objective is not to recover losses aggressively. It is to prevent losses from becoming catastrophic. Controlled drawdown is far more important than high short-term returns. Position sizing discipline is used instead of recovery tricks, martingale behavior, or grid-based risk escalation. This approach may look slower at first, but it dramatically increases survival probability. And survival is what allows compounding to work over the long term. Topic 7. Drawdown behavior and recovery. Drawdown behavior is a defining characteristic of resilient strategies. Maximum drawdown should be predictable and controlled. Unexpected or explosive drawdowns usually indicate hidden risk. They often appear after long periods of apparent stability. Drawdowns must also be recoverable within a reasonable amount of time. Long stagnation periods can be just as damaging as large losses. A resilient strategy accepts drawdowns as part of the process, but it keeps them within limits that allow the system to continue operating. Topic 8. Closing. The resilience mindset. When simplicity, parameter robustness, regime tolerance, execution resilience, disciplined risk management, and controlled drawdowns come together, the result is a strategy designed to survive. This is what separates fragile systems that look good on paper from resilient strategies that can operate in real markets for years. Finding resilient strategies is not about chasing performance. It is about building systems that stay alive long enough for performance to matter. And this mindset is the foundation of consistent, long-term trading success. Thank you for watching this video. If you found this content useful, take a moment to reflect on how these ideas apply to your own trading or decision-making process, and share in the comments. Give us a like, subscribe to the channel, and share this video to anyone who needs this knowledge. If you have questions or topics you would like to see covered next, feel free to leave a comment. I see you in the next video.